Hello and welcome to my class. So this is John Mazzara. I'm with Remax Results, and I've been selling homes for over 35 years. I started in 1986 when I was 21, right out of college. So I'm going to share, I've sold over 1,000 homes. So I'm going to share a lot of information with you in about an hour. I'm going to talk fast. If we meet in person, and I hope that we get to, I would be happy to go even more in depth into these topics. So the 10 secrets, and actually I'm going to give you two bonus ones at the end. So really we have 12. The first one is if you're into the housing market and you want to get some data as far as pricing in different communities and finding out what's going on throughout the metro and the Twin Cities, a website that you want to go to is mplsrealtor.com, like minneapolisrealtor.com. There's a markets tab, and under that you can check reports. Now this is an open website, which means that you do not need a password, and all of the data for all of the reports is compiled directly from the sales data from the multiple listing service. Now it takes the data to have occurred before the reports can be created, so everything's about a month old. But you can dig and go back years if you want to see trends. So if you want to see the trend from a year ago or 2 years ago within a specific community, county, or city, you can certainly do that. I'm going to just hold up here Minneapolis's report, and then I'm going to talk about some of the information that's on there. Okay, so one of the things you might want to look at is the median sales price. And so that the median is the data set in the middle, and it's maybe a better metric than the average. The average, can be skewed by very inexpensive or very expensive properties. The median is that data set congregated in the middle. And what it shows is a year-over-year comparison. So that month, but this year compared to last year, and then it shows a rolling 12 months. So it shows you kind of the trend, and that way you'll know if that particular month that you're looking at is part of that trend or if it's an anomaly. And I won't go into the data from this report because when you watch this, it'll all be different, but it gives you an idea of what's going on. It also gives you an idea of what list to sale price is. So right now homes are selling very close to list price or above. So they're selling at 100 to 99 to 102% over when everything is all averaged. What that means is that we have more buyers than we have sellers, a supply and demand imbalance, which means we're going to be involved in multiple offers. Now we've been in the multiple offer thing for a number of years in most communities, especially if you're in an affordable price range. And that affordable price range is maybe 200,000 to 450,000 for most communities. So be prepared that you'll unfortunately probably lose a home or two on the way to getting the home that you want. It gives you price per square foot. It gives you months of supply of inventory. Months of supply of inventory would be an indicator of whether or not there is an adequate amount of supply. Let's say 5 is equilibrium. Many cities and areas are between under 1 month and up to 3. So it depends on the community and the price range. But Minneapolis, they actually break it out then on the next page of their report by individual areas within the city. And they do the same thing for St. Paul. So here's St. Paul's, and you can see all the different areas in St. Paul. So again, that's free. You can go in there, monitor from time to time and see what's going on, or you can talk to me and I'll help you interpret the data. Another thing that we can do as agents is do comparables. So when you're ready to make your offer, we're going to go ahead and help you decide what is a fair offer based on what other homes similar to that have sold for. Another report that we have access to is the NAR-RPR report, where we can get an automated valuation. And then there's the tax values and other things that we can look at. So when you're working with an agent like myself, we're going to help you make an educated decision on what to offer. Okay, that's the first thing I wanted to cover with you, where to get some market data. Number 2 is things to look for in a purchase agreement when structuring your offers. It may sound kind of basic, but the closing date and the possession date, very important, especially if you're getting out of an apartment. You may have to be out by the end of the month, which means that you need to close and take possession before the end of the month. At the same time, if you're selling a home and moving in, you may not get possession until the first of the month. So if you close at the end of a month, you may be homeless for a couple of days in a hotel. So it is important for you to understand that those dates mean a lot. And a lot of people overlook them and then later go, oh, well, we need to make an amendment to the purchase agreement to adjust for multiple schedules, especially if you're part of a domino. A domino would be where one home is purchased and then those people are buying another home and so on and so forth. They're all kind of in a row. We call that a domino. And it's very important to coordinate because somebody has to go first and then all the dominoes can fall. So we have to close one first thing in the morning and then maybe mid-morning and then in the early afternoon and then at the end of the afternoon. And if anything goes amiss, then that can throw everybody's schedule off. So it's very important that all of that is coordinated so everybody can move peaceably and also end up with a clean home. So sometimes if you ask a seller for possession immediately and they have to go and can't get possession of their next home until the closing, they may not have time to sell yours, come back and clean, and then pack and move up into the next house. So sometimes it's better to give people maybe 24 hours to have more of a peaceable move, and then they can come back and clean. So if you don't get the home in the cleanliness condition that you had hoped for, it's probably because of how that timing was all lining up. Another thing that people talk about today in their purchase agreements is radon. So radon is an odorless gas through the degradation of uranium within the soil. It's naturally occurring and it can be greater in one particular home and the neighbor next door might not have any. So it's just an anomaly within the soil and what's actually in it. Testing levels, you can have that done as part of your inspection. And most often we'll see that the seller will be agreeable to fixing it. It's usually a $1,200 to a $2,000 fix for a basic system. And that would be if the level is over 4. That's kind of the level. It's called 4 picoliters is the level that it might be recommended that something is done. When you purchase a home, part of your purchase agreement will give you information on radon, and then you can choose for yourself whether or not it's something that you want to test for as part of your home inspection. And you can if you want, and then if that's at a certain level, you can either request that the seller pay for it. It is a negotiable item, or you can address it later after you own the home. Another thing is rent backs. So sometimes you may want to get your funding in place as a seller early so that you know that when you buy that you can go ahead and complete that transaction without having to worry about something blowing up, especially if there's going to be a long possession period. So maybe what you do is you close sooner, you receive the funds, you know that your home is sold, and then you rent back from the new buyers until you can actually get access to your next home. A lot of buyers are open to doing that as long as they know they're going to get their home, especially in a tight market where they'll do almost anything to get the house. So they'll work with you a little bit more as a seller. And that's something you could offer as a buyer to make your offer more attractive. That you'll close earlier and allow them to do a rent back. Most mortgage programs require that you own or occupy within 60 days from a closing. So that rent back period can't go forever. It can go for like a maximum of up to 60 days. And your lender, you can check with your lender, of course, but that shouldn't be a problem under most programs. And the other thing that is going to sound really basic again that I always do is I pick up the phone as an agent and I call the other agent and I have a discussion about what the sellers need, what the buyers need, and how we should structure the offer. In today's digital world, unfortunately, the lost art of communication has taken place. And so today it's texting and email, which is how we deliver the offer. Generally is through email. We don't present in person anymore. But prior to that, I think a conversation certainly is warranted. And you'll win a lot more offers by having that conversation. So that's one of the things I'm going to call it old school, even though it doesn't really sound like it should be. But the lost art of communication on a phone should be part of any transaction. So as you're moving forward and you're making offers on properties, because of the tight inventory, if you like a home, so is somebody else. And that is unfortunate because there can only be one owner for that home. But how can you make your offer better? Well, in the olden days, 1,000, 2,000, 5,000, even up to 10,000 generally was enough to be in it to win it. Not so much today. Today we're seeing offers of 10,000 at a minimum on up to 40,000 depending on the price range of the property. So if a buyer really wants a house, or if you're that buyer you want to be prepared for making a very large offer over list. And you might be, I'm going to say, exceeding the current valuation of the market today. If it's a long-term purchase, something you're going to be in for many, many years, that might not mean anything because you've got what you want, where you want. And if it's a long-term, 10, 15-year commitment on a house, an extra $10,000 to get it doesn't really mean anything. It would mean more if you're going to be in it on a short-term basis. But you'll decide for yourself as we go and look at homes, what that home is worth to you, and you'll see the value, and you'll recognize that that may be what you need to do in order to win it. And again, the market ebbs and flows, and right now the strength is certainly in the hand of the seller. But at some point that pendulum may swing back, in which case the strength will be in the hands of the buyer when there's more homes than there are buyers. But that's not the case right now. And actually, if we look at who's entering the home buying market today, it's millennials. The average home buyer today is first-time home buyers, 33 years old, and there are more millennials than there are boomers, and boomers moved markets before. So it's very likely that, in my opinion, that the housing market will remain strong for a long time, especially if interest rates are low. Right now they are at historic lows. They're in that 2 to 3 range. As interest rates rise, if they do, that will decrease people's purchasing power and push people out of the market. But as long as they're low, it allows them to pay more for a home and have a reasonable payment. So if interest rates stay low and as the millennials start to continue to purchase, the housing market should remain strong. Due to our national very large debt, I think the government, by hook or by crook or whatever they need to do, will be doing whatever they need to do to keep the interest rates low, because just paying the interest on our national debt it would be too onerous if interest rates rose. Now that's assuming that they can control them, and who knows if they can and to what extent. But that's just my feeling on where things might be going to the future. Other things that you can do in your multiple offer then, besides making a strong bid, is to bid in something other than a zero. So most people bid 1,000 or 5,000 or 10,000. Instead go 2,000, 6,000, 11,000, 21,000. Do it in an odd number. Too many people end it just in a reasonable amount, but one that can easily be beaten. If people are looking only at the bottom line, then they're going to take that offer that's $1,000 more. So I would bid in a slightly off amount over list if you're going to be bidding in a multiple. Another thing that I'm seeing here recently is that people are having inspections, but they're making their offer not subject to that inspection. So if the home is in reasonable condition and they feel that whatever issues that are there that they're going to be able to deal with at a later date, they'll say, hey, you know what, I still want my inspection for my peace of mind, but I'm going to buy the home regardless. So I'm seeing that, or just waiving inspections altogether. I'm not endorsing one way or the other, but that's one way to eliminate a contingency in that purchase and make your offer more attractive in the eyes of the seller. Other things are financing and being underwritten. So when you're making an offer, you need to have an approval letter. Now that can be something online that you've created, garbage in, garbage out. You pushed a button and you've generated a pre-approval, or it's actually called a pre-qualification letter. Or you could do a pre-approval, which is much stronger, which means somebody's actually looked at your information, a loan officer put it into a computer program and pushed a button and gotten an approval letter. Or better yet, is an underwritten file, which means you've gone all the way through, you've provided your pay stubs, your bank statements, your tax returns, any and all of that information, so that all that is left is the appraisal on that home and the title work. That's a pre-underwritten file. That makes you the strongest. So if we're a seller, again, looking at multiple offers, and I have the person that did their own little pre-approval letter online from an automated website, the one that's met with the lender, or the one that's met, now they met the lender, but that's taken it all the way through underwriting, I'm going to go with all things being equal, I'm going to go with the underwritten file, because I know I'm not going to have problems with the borrower. I might have problems with the appraisal, but if somebody's bidding over, but that's something I'm going to have across the board. The more people put down on a home, the less risk there is to the lender, and the less chance, in my opinion, that you're going to have issues with that appraised value. So again, if you can come in with a larger down payment, that's a stronger file. Other things such as closing costs, there's all sorts of different ways to cover closing costs, which I'm going to cover here in the next couple of bullets, so I won't spend a whole lot of time. But ultimately, your offer and the net of that offer is what the seller is going to be evaluating. And I would discourage you from writing letters, or love letters we call them, to a seller, because honestly the seller doesn't want to see that, and probably shouldn't see that, in the sense that they don't want to be on the hook later for any type of allegation that anybody could make that the offer was a rejected offer was rejected based on some form of discrimination. So if it's evaluated solely based on the closing date or other terms and conditions, the financing, and a down payment, then it's clean, then that allegation is removed. So if on my listings we get a letter, for example, from somebody, I'm going to recommend that the buyer or the seller carefully consider before they open that whether or not they want to even be a part of that. And it may be in their best interest as sellers not to look at any of those letters. So I don't think that that's something that I would recommend that you do as a buyer, and I don't think I would recommend necessarily that you look at it as a seller. So maybe skip the love letter. Okay, the next thing is credit. So before you buy a home, you're going to have to, again, make that lender application to some degree in one of those 3 different ways that we talked about. And before you even go there, you may want to pre-check your credit. A couple places you can do that. One is creditkarma.com. Another one is annualcreditreport.com. Annualcreditreport.com gives you a report without scores for free, but you can check that and see if it's reporting accurately. If it is reporting something inaccurately, then you would challenge that at the bureau, get it removed before you make your loan application so that you can be evaluated properly. The higher the credit score, the more mortgage programs are going to be available to you. If you're getting mortgage insurance, the less expensive it will be, the higher your credit score. So your credit score is extremely important, and I recommend that we take a look at it in advance so we talk about it so we can see what ranges on programs that you might be eligible for based on your range. For example, many lenders look at 640 as a baseline for an FHA loan. Now, there are some lenders that go less than that, yes, but as a generally speaking at this time, that's sort of a baseline. You typically have to have a 680 or above for a conventional loan, not necessarily at all lenders, but if you don't, you're going to have very high mortgage insurance unless you put 20% down. So credit score is very important, something to consider. And again, those are 2 sites that will allow you to look at your credit free before you begin the home buying process. Okay, I mentioned earlier about closing costs. How do we get those covered? You may have just enough for the down payment, but you don't have enough for the down payment and closing costs. How can we figure that out? How can we still get you into a home? Well, there's 3 ways. Well, one is, of course, if you were able to get them through a gift or through your own resources, maybe a loan from your 401k if you have that, a gift from a parent or relative, then you can cover the closing costs that way. Another way, of course, is that you can ask that the seller pay them. You can make that a part of your offer where you could say, I'll pay you X, and out of that you pay Y for closing costs. Another way is to add them to the top. So you can say, I'll pay you X plus the closing costs. So it's added to the top, and then the seller pays them. Effectively, you're paying them through an increase in the purchase price, but they're financed. As long as the home appraises, then it's no harm, no foul, and you have basically about a $4.50 a month payment for each $1,000 that you borrow. So if you added, what would that be? If you added 5 times that, $5,000, it would be $22.50 extra a month that you would be paying for that extra $5,000 that you added to the top. Let's see. Another way you could do it, depending on the loan type, you could do what's called lender-paid mortgage insurance. That's for conventional loans. That's if you have a very high credit score, and not all lenders do that. Some lenders do, some lenders don't. Another way is that you may be able to get a credit for the closing costs from the lender. So let's say, for example, that the interest rate was 3%, and you're more than qualified to buy at 3%. You could ask the lender, well, what if we raise the rate to 3.5%? How much of a lender credit are you going to give me towards the closing costs? And depending on the purchase size, you might find that there's enough credit to cover the closing costs. Now, not all lenders will do that. So some of the things that I'm mentioning today cannot be done by certain credit unions or certain banks or certain mortgage brokers, but they're available. So if you find that whomever you're speaking with doesn't offer that, then we need to have a conversation about who else can you speak to. And I'm happy if we're working together to provide you with all sorts of resources with regards to financing and programs. Some lenders will give you special closing cost credits. I won't mention any lenders here, but there are lenders that will do that. There are also affinity programs with some of the larger banks that have a relationship with unions and also certain large employers within the Twin Cities where you get a gift card after closing. So depending again on your career and the person or the lender where you're getting your financing, you may be able to stack some of these different things. There's also the Minnesota Housing Finance Agency, which offers grants and programs for closing costs. They have one program that you can get in, at least as of this time, for $1,000. You need $1,000 out of your pocket, and then you can borrow the difference for the closing costs and the down payment. There are income and credit restrictions, of course, on these programs, but that's one of like 3 or 4 programs that they offer. Not all, again, banks and lenders work with the MHFA, the Minnesota Housing Finance Agency. So again, if you've never heard of some of this before, it's because maybe the people you're speaking with don't have access, but it's available. And that's why working with somebody like me that's been around for quite some time knows and can direct you to match what you have and what you're bringing to the table and what you might need. So those are just some of the different options that are out there on how to cover your closing costs. Let's talk about next the types of loans that are in existence. So there's typically 3 types of loans that you're going to encounter. FHA, which is a federally insured loan. We have conventional loans that are underwritten by Fannie Mae or Freddie Mac. It's a quasi-government agency, if you will. And then we have veteran loans, which are for veterans. Those are called VA loans. So unless you're a veteran, you're not going to be eligible for a VA loan. Now, the FHA and VA typically underwrite the property more stringently, meaning they look at the condition. They're very picky on the roofs, the functionality of the windows, and any flaking lead-based paint and or other structural issues. So if you're buying an older home, possibly a fixer-upper, for example, you're going to run into difficulty with using FHA or VA financing, most likely. With a conventional loan, they also can add work orders and find problems. It's just that they're much more lenient, and their leniency becomes greater. What I've found is the larger amount you put down. So some homes that have more scratch and dent or bumps and warts, if you will, those homes are best financed with conventional. And again, you need a certain credit score to be eligible for some of those conventional products. So that the type of financing that you're approved for may limit the type of property that you're able to get. Now, there are special rehab loans as well. The FHA 203K, for example, is a rehab loan that lets you borrow money to do the repairs. So that's an FHA product that would recognize the scratch and dent component of that house and allow you the money to do it. They have 2 different versions, the FHA 203K Lite and the full, and there's different parameters on each. But know that that product exists, and there are some conventional rehab loans as well. So again, knowing the resources where to find these loans will help you put together a transaction. And if you're not aware of it, you may be passing homes that would work for you, but you didn't know how to get it done. So hopefully this is helpful. Let's see, what else can I tell you about that? I guess the other thing is there are some Alt-A lenders that are coming back into the market. So if we go back in time into the 2000s, we had lower documentation loans, and that kind of got the market into trouble. Some of those products are back again. So with the larger down payment, we have bank statement loans, we have other lower documentation loans that might work better for somebody that's self-employed, that has more difficulty with documenting all of the inflows of their cash flow other than through their bank statements. Maybe they write everything off, but they have great credit and they've never had a problem. It's just they don't fit the conventional guidelines, if you will. So Alt-A is creeping its way back into the marketplace. where it was non-existent after the foreclosure crash. It's now back to some degree. So if you have a unique situation, again, it doesn't mean that we can't get it done. We may not be able to get it done with conventional lenders, but it doesn't mean that we can't find an outlet. Let's see, home inspections, that's what we're going to talk about next. So if you decide to have a home inspection, you can have a home inspection done with a company. You can have it done with a relative or friend. You can have it done by both. You can have it done by somebody in a certain trade group. You can make that part of your inspection. Typically, inspections, when we add them to the purchase agreement, we have a 10-day window to complete all of the inspections, and from that, any negotiations that may need to be done with regards to items that we've discovered. And that's a point of negotiation. So even if we've discovered it, it doesn't necessarily mean that the seller has to do it. It means it's a point of negotiation. And if there are, let's say, 5 other offers stacked up behind ours, maybe we won in a multiple, we don't necessarily want to be too picky, because they can reject us and go right with another offer. A lot of times what will happen in a multiple offer situation is a seller will receive, or the listing agent will receive, a call from the agents that lost, and they say, hey, you know what, if that deal falls apart, you let me know, we'll take it as is, no problem. So many sellers know that there's a backup or two waiting that will not give them a lot of requests for things. So tread lightly during your requests, especially in a multiple offer in a hot market. So an inspection, I oftentimes say, will tell you that it's more so you get to know the home and create your list of items that you'll address sometime during your ownership. Again, many of these homes are older, 50, maybe even 100 and some years old. So it's not going to be up to code. So know that too. The seller isn't going to bring your home up to code and replace everything, especially if it's working. It might have been code 20 years ago. It isn't code today. It doesn't mean that it needs to be done. Might like to have it done, but it doesn't mean that it has to be done. What I'm finding is that sellers that have owned multiple homes understand that. First-time buyers sometimes, maybe not so much. They look at the inspector as the authority, and they listen to maybe their parents that bought 2 homes over their entire lifetime, telling them all that should be fixed, not understanding that this is a different market, and that isn't necessarily what's going to happen. You lose the home if you push too much. So just be careful with regards to that. Understand what's really important and what isn't. Hazardous items, like it's leaking carbon monoxide, that's an important item. Changing out some of the 2-prong outlets to 3-prong and grounding them, maybe not so much. Again, each home is different, but don't expect a seller to bring it up to new construction. If you want new construction, we can take you out and show you new construction. So with regards to inspectors, if you hire a formal company, you typically get a report. The report typically is, I would say maybe 40, 50 pages with pictures documenting issues that they found in the home. Now, you've paid them to find problems, so they're going to find problems. If you didn't want to find problems, why hire them? You know, you're there. If they gave you a report that said the home was perfect and you paid them $500, are you going to feel good? You're going to feel like you got ripped off. So they're there to point out all the stuff, even if it's little and maybe even kind of insignificant. They're going to justify that $500 that you paid. Now, as of right now, do you know what the criteria is to be a home inspector? Okay, there isn't one. So what that means is that there's a big skill gap between inspectors. So one inspector might actually have some construction or trade knowledge, and the other guy or gal went and took a weekend course and bought a franchise. So just understand that sometimes when an inspector says something, it isn't necessarily true. I've had inspectors say that roofs were bad when they weren't, and we've had them, documented and checked by other contractors and by the insurance company and the adjuster and all of that. So I've had those situations where issues have been made where there really wasn't an issue, or saying egress windows weren't egress when they were, or just a multitude of different things. So just make sure that you understand the skill of the inspector, understand that there isn't any criteria to become an inspector at this time. There's no licensure. So it will vary, and talk to other people besides the inspector if you're concerned about something. Maybe verify it for yourself, call the city, talk to the city inspectors, Google it, whatever. Understand that some of the information is maybe overkill from the inspector with regards to a scare factor, because they're trying to CYA themselves and provide value. But sometimes they go a little overboard or speak out of school. So understand that's what you're going to get in the report. That's the basic report. In addition to that report, you can do additional add-ons. So typically you'll be offered the ability to add a radon test. They bring a machine out, they set it up, they wait 48 hours, and they come back and pick it up, plug it in the computer, and get the results. That might be, I won't quote prices, but that'll be an add-on that you'll be able to get with the report. And a sewer line. So you can also have a sewer line checked to see how it goes out to the main. That might be very important on an older home in Minneapolis or St. Paul, but not necessarily so important on a new or newer subdivision out in Farmington or Lakeville, for example. Of course, you can do it on any home, but in order to prioritize where you want to spend your money, on the newer home, that report might not be so important. You could have over $1,000 into reports by the time you're done and still not get the home if you decide to walk away. So know that if you pay for an inspection, those are your reports. You don't get any money back if you walk away. Now, if we're buying a lot, we're doing soil borings and something like that, then we might have a discussion or a survey on some cost splitting. But a basic home inspection and the add-ons to that, that's typically a buyer-borne cost. And then from that might be coming some requests, typically limited to hazardous items that were discovered, or some items that should be fixed or could be fixed, like GFIs, for example. GFI is a ground fault interrupter, and you have to have them if they're next to water. So in the bathroom, the outlet that's next to the sink, or in the kitchen, the one that's next to the sink, those should all be GFI'd from a safety perspective. That's generally fair game. They're cost $40-50 for the unit, and then the cost of the electrician to come out and put them in. Not a big cost thing, and it's a safety thing and a valid one. So that's a typical one, and most people don't receive too much pushback on that. I have had requests, to repaint and to do crazy things like that, and we're just not going to do that. So sometimes a seller, if you push too hard, the seller's just going to say, I don't think this home is for you, and send you on your way. So again, be careful, be reasonable when you do your inspection. Okay. Another thing to talk about is homes that have issues, and are they issues that can be fixed? So for example, what if you find a home that's very close to where you want to be, close to work, close to school, close to your religious institution, family, whatever. It's very close to parks, whatever. It's very close to everything you want. But it's an older home, let's just say in Minneapolis. And in the older homes in Minneapolis, they didn't put in drain tile. Drain tile is what you put in around the foundation to capture the water when it comes in through the walls and then goes into a sump pump and is pumped up. So they may have water in the basement. Maybe it's in a corner. Maybe it's all throughout the basement. A solution or solutions might involve regrading and adding landscaping, adding gutters, and adding an interior drain tile system. Maybe we're talking $5,000 for the interior drain tile system and $2,000 for gutters and another $2,000 for landscaping. So approximately $10,000 we can resolve and fix that problem. Instead of walking in and going, water in the basement, can't buy this home, no good, mold, gotta go. Now you can say that, that's totally fine, except that a lot of the homes that are in the city, of either city, that are older, didn't have the drain tile, and unless it was added by a seller or a previous owner, it won't have it. But there is a solution to that. There are a number of different types of water remediation systems, drain tile systems, that you could look at. And so I'm not saying to buy a home like that, but I am saying you might want to consider it and look at the remediation as a way to make that home functional for you. Same with obsolescence. So let's say you go into a home and it's got a lot of funky wallpaper and orange shade carpet and avocado appliances and original cabinets. And again, it may be everything else that you want. It's the prime location, but it has all that stuff. And you're like, boy, I just don't know that I have enough money after I buy this home to be able to go ahead and, I used up all my down payment. I don't have enough money to do the upgrading and updating, and it's just not the way I want it. So I'm going to pass. That would be where you might want to consider using a rehab loan. And that is the FHA 203Ks or some of the conventional rehabs that I referenced. So you can borrow the money to do those repairs. It's put in an escrow account. And then there are conditions on how that money is released depending on the program. And that allows you to do the work to get it to what you would have wanted it to be in the beginning. And it does not, depending on the program, it does not have to appraise dollar for dollar. So it just has to appraise for a small percentage, meaning the after repair value doesn't have to equal what you paid to do it. Because we know that when you spend money to do remodeling, you don't always get a dollar for dollar. You might get 50 cents on the dollar. Some remodeling, you might, like putting in a furnace, you might get 10 cents on the dollar. So it isn't the dollar for dollar, and the lenders understand that. That's why they allow it not to have to appraise for the equal amount that you put in. So if you had never heard of that loan, you might be, again, excluding homes that you could make work with the right type of financial program. So that would be the rehab loan that I'm referencing. Let's see. Next thing I want to talk about was purchasing an investment property. So a lot of people will approach me and say, I would like to be a landlord someday. Now, I've been a landlord. I am a landlord. I've been managing property for my family and for myself for, again, 35 years, right? Ever since I've been selling homes. And I think it's a very positive thing. It isn't for everybody, but if that's something that you want to consider doing, what I would say is you may want to make that your first purchase rather than your second purchase. And here's why. You can utilize much greater leverage by being an owner occupant in a rental property than buying a rental property after the fact. So if you were to use an FHA loan, for example, you could buy a duplex or triplex with 3.5% down, fourplex with 5% down, and owner occupied. So that's the criteria. You must live there. But there isn't any length of time. I would say, if you live there for a year, that might be reasonable. Move in and then save up enough money to go ahead and buy that house that you would have bought first. Now, if you do it the other way around, you buy the house and then you want to buy investment property, you're going to need 20 to 25% down. Instead, you could do 3.5% down using FHA to buy the investment property, live there for a year, and then turn around and buy another home conventional with 3% down. That's assuming that you earn enough income to qualify for both properties. Assuming that you do, then you'll be able to do that. But now you've got one property leveraged at 96.5% and the other one at 97%. That allows you to utilize a lot less capital out of your pocket to accomplish what you want to do, but you got to stagger it, and stagger it as the investment property owner occupied first, then buying the home with the white picket fence second. So you got to stagger it a little bit. And a lot of people have never thought of it that way or even considered it. But if you move into a multifamily, which would be a duplex, triplex, or fourplex, you could effectively live very cheaply as the tenant is paying off the majority of that house payment. Again, it depends on what price range that you buy, but you could have 2/3 of your house payment covered by your renter. So a great way to build wealth, pay down debt, and get your first investment property in place. Another thing, title insurance. So I use independent title companies. There are company-owned title companies. Our company happens to own a title company. It could be one that you could consider, but you are in charge of ultimately deciding where your title work will be completed. And some companies from my competitors and other companies don't necessarily have the most competitive title insurance charges. And so what I would say is get a quote, compare it yourself, but just know that you don't have to utilize the title insurance company that happens to be owned by the mortgage company of that same company. So you may see some vertical integration, especially if you're not working with me, and know that you don't have to participate in that vertical integration if you don't want to. and you may or you may not want to, based on cost. So you are always free to get a mortgage wherever you want. You are always free to get your title wherever you want. So just to know that you have that flexibility, even if you enter into a vertical integration. I like to work with very, very competent people that I have long-term relationships with. They are not always the cheapest, but they're always in the game, and they always do a great job. And I think what you want through the transaction is as painless as possible transaction. You'll find buying a home, at least if you're working with me, to be very upfront and a fun experience. I'm going to be your protector. I've been doing this again a very long time, over 35 years, and over 1,000 homes. So I'm going to point out things in the home, and I'm not going to let you just buy any old home. I'm going to point it out so that you have kind of like a pre-inspection as we're going, with regards to the condition, things that you want to consider. And that would be in addition to your home inspection that you would, get later on down the road. But I want you to have your eyes wide open before you get to that stage so that we can decide to go forward or not. I'm going to point out a lot of things on this property or properties as we go. Same with if you ask me to help you with regards to your financing and title, I will give you the name or names of people that you can speak with. You're under no obligation to do business with any of them, but I have plenty of resources at my fingertips that I know are competent that will get you to the finish line painlessly. The last thing you want to do in anything like a large purchase like this is be the education for somebody else. And that takes me to the next tip, which is you may have friends or family that have just recently gotten into this business that don't do between 40 and 50 transactions a year like I do. And you want to help your friends and family, but they don't have the background and the experience. And certainly with regards to investment properties, most agents, as crazy as it sounds, have never owned an investment property. So if they've never owned it and don't know how to do it, how could they ever advise you how to do it? I liken that to the blind leading the blind. So don't be somebody else's education. Don't let them learn through your transaction. Pick somebody, whomever it is, that you're going to work with that can provide you the knowledge and the experience so that you make the best decision that you can make going forward in your real estate. It really does make a difference. Trust me. It will make a big difference. And you're only going to probably do this 3 times in your lifetime. It doesn't cost any more to work with one person versus another, but the experience to you can be dramatic. And then the last tip I'm going to give you is with regards to homeowners insurance. It's just like title insurance. You have the option of picking whomever, whatever you want for a company. You could go online and pick a company, or you could work with a knowledgeable agent or broker. There's advantages to both. You might get a quote from a couple different companies. One thing that you may find if you're stretching with regards to qualifying to get into a mortgage and into a home is that you will max out your debt ratio. So you're allowed to have a certain amount of your income go to your principal, interest, taxes, insurance, mortgage insurance, and your aggregate debt. Maybe that's 45%. Maybe it's between 40 and 50 typically. It's all program dependent, credit score dependent, and lender dependent, and they're overlays. So it's a combination of all of that. If you need to bring your ratio down so that you can purchase more, one of the variables in there, the PITI, is the I, and that's the insurance. So my last tip is if you're really tight on your ratio and you need just a little bit more to get where you want to be, you could go with a higher insurance deductible on your homeowners, which would lower the premium, which means when they calculate that ratio, that component in the ratio would be a little bit less. The other thing with regards to the private mortgage insurance component, other than FHA, that is tied to your credit score. So that's again the importance of making sure that you check your credit. And I have a lot of credit tips that I can share with you. I only have so much time on this video, but lowering your utilization, increasing your available credit, making sure that there isn't erroneous information that's reported. I'll go over other tips with you, if we speak, but make sure your credit score is as strong as it can be, because it will be very impactful throughout your process. With that, again, thank you for watching. My name is John Mazzara. I'm with RE/MAX Results. You can reach me at john@johnmazzara.com or 612-386-7027. I would love to help you, and thank you, and good luck.